In this video, I'll be revealing the exact savings targets that you need to hit at 10 years, 5 years, and 1 year before retirement in Canada to ensure that you can maintain your lifestyle without running out of money. We've helped hundreds of Canadians plan their retirements over the years, and one thing I've noticed is that most people seem to be flying blind. Like they follow kind of generic save $1 million type of advice, or they copy paste the rules that they saw maybe on an American channel, but those numbers just don't fit our system up here in Canada, where we've got things like CPP, OAS, RSPs, and TFSAs, and they all work together in completely different ways. So that's exactly why I'm going to make this video here today, to show you the precise savings benchmarks at each critical stage so you know exactly where you stand and what adjustments you might need to make. Let's dive right in. Hey there, I'm Steve Willems, a wealth advisor with the Willems Wealth Planning Group out here in BC. On this channel, I help Canadians plan smarter retirements, reduce their taxes, and make better decisions in the years that matter most. So if you've ever Googled how much should I save for retirement, you've probably seen charts from US firms, right? Vanguard, Fidelity, JP Morgan, all giving neat little checkpoints. The JP Morgan Guide to Retirement is a great example. It tells a $100,000 earner that they should have about $565,000 saved by age 55 and nearly $890,000 by 65. Sounds simple enough until you read the fine print. Says those figures factor in assumptions around Social Security. And that is an American hot potato that doesn't exist up here in Canada, right? Like we've got CPP, OAS, provincial tax systems that look nothing like what those numbers were built around. So when Canadians try to apply those benchmarks to their situation up here, the math and often the reality tends to fall apart, because here's what usually happens. Some people see those US numbers and they just outright panic. They think that they'll never be able to catch up. Others are going to see their CPP and their OAS projections. They're going to assume that they're fine, maybe without realizing their tax or their withdrawal strategy might not be. Like either way, they're planning in the dark. Now, when I meet someone for the first time and I've got maybe 5 minutes to quickly assess their financial health as it relates to their retirement, I use my own quick diagnostic. In healthcare, right, they've got the ABCs, right? Airway, breathing, circulation. For retirement, I've got my own version, right? A is for assets, like what you've saved and where it's located. B is for the base income, right? The guaranteed flows like CPP, OAS, any pension income that you're going to have coming in automatically. And C is for cash flow, how much you actually will spend and what that translates to after tax. Once you've got those 3 numbers in view, you can finally stop comparing yourself to some arbitrary American benchmark, and you can start measuring against what actually matters up here in Canada. So let's ground this conversation in something real. Here's what on track actually looks like, starting with that 10-year checkpoint before retirement. So at that 10-year mark, retirement is starting to feel real, but it's still far enough away to start to make some meaningful moves. For most Canadians, that's somewhere in your mid-40s or maybe your mid-50s. Kids might still be at home, or maybe you're helping them a little bit with their post-secondary costs. The mortgage is probably finally within striking distance. Your income is usually near its peak. Your career is established, and for the first time in decades, you're starting to look at those RSP and TFSA balances, and you're thinking like, this is starting to add up. This is the decade of growth. Your decisions right here determine how strong the runway is going to be for everything that comes next. Because here's the rule of thumb. My back of the napkin for this stage is seeing 6 to 8 times your annual gross income in some form of investment asset at this point. It doesn't have to be liquid financial assets, but it does need to be investments, right? So think RSPs, equity in rental real estate, TFSAs, cash in the bank. I wouldn't be counting the home equity in your principal residence here, importantly. Now, at this level, compounding can finally start to do the heavy lifting from you. It's going to start to shoulder the weight that your savings rate was carrying for the last period of time. With 10 years left until retirement, you've still got enough time for market growth to double your savings if you stay disciplined. But this stage also comes with a few critical traps that you want to make sure that you avoid. The first is you're going to want to avoid lifestyle creep. This is the danger zone where often you can see your income rise significantly, but your spending can quietly keep pace. Here, every extra vehicle upgrade or vacation that kind of gets normalized into our life's expectation chips away at our future freedom. The hot book on this topic is Morgan Housel's new book, The Art of Spending. It's a great read. Go grab it if you haven't read it yet. It'll help you make sure that you get this part right. Second, you want to make sure that you're continuing to scale your savings rate. Ideally, you should see your savings rate in this stage really step up to say 20 or 25% of your gross income. Now that the major financial fires, right, like your mortgage, your kids, their education, are hopefully all under control. A third, you're going to want to keep costs low. This is not the time to get fancy with high fee investments or speculative plays. Simple, broad, globally diversified portfolios are usually going to outperform the story-driven ones. But equally important here is that an overly conservative investment mix at this stage can also totally destroy your future options, right? Like say if you're parked in a GIC for 10 years and you experience half of the return that you otherwise could have earned if you were just paying attention. And lastly, you're going to want to plant the seeds for future flexibility. You got to keep filling that TFSA every single year. If the TFSA is full, you're going to start filling up that small non-registered account. These are going to be flex dollars that are going to give you spending options later on that won't come with a tax bill associated with them. You can kind of think of this phase as your like financial mojo decade, right? Like you're earning well, hopefully your confidence is high, and the compounding math is finally starting to work in your favor. The key is to lock in these habits while the wind's at your back, because in about 5 years, your mindset, you're going to find, is going to start to shift. It's going to shift from pure growth to protecting what you've built. So let's talk about what's next. So at 5 years, we're now getting closer to that on-ramp, the final 5 years before retirement. Now, for most Canadians, that means you're somewhere in your mid to late 50s, perhaps. The kids are likely launched or maybe hopefully close to it. The mortgage is either gone or nearly gone, and you're starting to run some like what if math on a spreadsheet at home in the evenings if you're honest. Like what if I stopped at 62 instead of 65? What if I went part-time for a couple of years? That type of thing. But here's the reality for this stage. My back of the napkin for this stage is seeing 10 to 12 times your annual gross income in some form of investment asset at this point. And this range now actually starts to matter, because by this point, compounding alone won't make or break your plan. Sequence of returns risk may. A bad market in these years can do more damage than a decade of good savings can fix. So what we'll find is that the goal here shifts from maximum growth to steady, intentional preservation. Subtly, many folks don't even realize that this shift has happened in their mind. This is when you should start tightening up on the details. Number one, you want to dial back on your risk slightly. I'm not talking about like go to cash levels, but just rebalance so that a portion of your portfolio is ready to fund the first few years of retirement income, regardless of what the markets do. Next, you're going to stress test your plan. I'm talking about running a few what if scenarios, right? Like what if the markets drop 10% next year? What if inflation runs higher for longer? Can the plan still work? Third, you're going to want to check your income mix, right? Are your future sources of income all coming from RSPs, or do you need to have some tax diversification seeds planted now so you've got some mix of investment income coming from your RSPs, your TFSAs, and then your non-registered accounts, right? That mix is going to matter soon. Next, you're going to start building your future retirement spending budget. You're going to want to see what your life actually costs you when you remove the savings line item, when you remove the mortgage payment line, when you remove the young adult, kid, child support payments. For many people, retirement living costs around 60 to 70% of their pre-retirement income once saving, debt, and those work-related costs fall off. This is also the stage when the conversation shifts from how much can I save to how much will I get paid, right? In other words, you're starting to build the bridge between wealth accumulation and income generation. If you're sitting at this benchmark, right, like 10 to 12 times your income, you're pretty much in the zone that I'd want to see. It means you've built enough to start shaping your exit strategy on your own terms, not your employers, and certainly not the markets. Now that you understand that 5-year benchmark, and if you're there, and if you need help building out your own plan, I suggest you click the link in the description below to book a call. I'm happy to analyze your specific situation and help you make sure that your retirement plan is optimized as a whole. And now let's fast forward to that final checkpoint, like 1 year out, where the numbers finally stop being theoretical and they finally become kind of real world income decisions. Now, this is the moment when all of those years and the savings and planning all kind of come together into something real. The spreadsheets are going to get really specific. The countdown clock's going to start ticking. At this stage, the benchmark is pretty simple. If you're earning $100,000 a year, you should have between 1.2 and 1.5 million bucks across your RSPs, TFSAs, and your non-registered accounts combined. So that's going to be about 12 to 15 times your household gross income. But here's the real test now. It's not just about how much you've saved. It's about how well you understand where your income is going to be coming from. Because by this point, you should have a pretty clear picture of your guaranteed income sources, right? So things like CPP, OAS, any defined benefit pensions. You should know your variable sources, right? RIF withdrawals, non-registered investments, rental income, maybe part-time work or business income. And you should also know your release valve, your tax-free sources, right? Your TFSAs should now start taking a more visible role in the flexible bucket for cash flow, if that's even needed. Now, keep in mind, each of these income types hits your tax return differently. And this is where most near retirees miss the mark, right? Because those RIF withdrawals are going to be fully taxable. Any eligible dividends you're earning in your non-registered portfolio, those are going to be grossed up. The capital gains, only half of that's going to be taxable. And your TFSA withdrawals are obviously tax-free forever. And so this is going to be the year where you're going to want to make sure that your future income is efficient, that you're not just accidentally triggering higher marginal rates or OAS clawbacks just because your income sources aren't balanced or calibrated properly. It may also be time to make sure that your assets match your timeline. And this is especially common for business owners or maybe accidental business owners like doctors or lawyers or professionally incorporated engineers, right? If you've got illiquid holdings, maybe a limited partnership or a private loan, maybe a land development project, it's time to start winding those down, or at least ensuring there's a path towards liquidity. Because the last thing you want is to step into retirement and realize that a big chunk of your net worth is tied up in something that you can't easily access. This is not the season to be doubling down on long-term illiquid investments. It's the season to shift from building wealth to drawing on it, and hopefully smoothly and predictably. And for most people, this is also when we're going to start locking in the actual withdrawal mechanics, right? Deciding when to convert RSPs to RIFs and how much. Are we going to do the whole account or just a part of the account? How much withholding taxes should be set up on those income streams? We're going to be planning when CPP and OAS should begin, right? Like we're going to test that out under a few different scenarios. And we're going to want to determine how much should flow out of the TFSA each year to top up that after-tax income need. Or maybe it's not even needed after all. And for many, that's the case. Because here's the thing, by this point, you're not trying to maximize return. You're trying to maximize confidence. This is, after all, the point of peak uncertainty in your life. Your net worth is the highest it's ever been. Poor decisions are very difficult to recover from at this point. Your confidence suffers. So the key is just knowing exactly how your paycheck will continue. So if you've hit that 12 to 15 times income range and you've mapped out where the dollars are coming from and how they'll be taxed, then congratulations. You've reached the point where you can retire with clarity and not with guesswork. Now we need to look at how to coordinate these income streams, right? CVP, OAS, the RIF, to make sure that your cash flow is not only sufficient, but tax optimized. Because everything we've talked about so far, right? The 10-year, the 5-year, the 1-year benchmarks, it gives us a clear sense of targets. But if I'm given more than 5 minutes to help someone answer that "am I on track" question, this is where the conversation always goes. Because what really determines whether your plan works isn't just about how much you've saved, it's about how all of these moving parts are going to fit together. For most Canadians, there are about half a dozen key decisions that need to be made, and they're all interconnected, right? Like, when do you take CPP and OAS? That one decision alone can change your guaranteed lifetime income by tens of thousands of dollars, often hundreds of thousands of dollars. If you start too early, you might miss out on meaningful increases later. If you wait too long, you could end up draining your personal savings unnecessarily and adding other risks into the plan. When do you trigger your RSP to RIF conversion? If you leave it too late, you risk walking straight into that tax wall at age 72 and forced minimums kick in. If you convert it earlier, you can smooth out your income across a bunch of years, keeping those clawbacks at bay. But again, what happens if you erode that savings too quickly? How do your defined benefit pensions fit into this whole mix, right? Like, if you turn them on at the earliest unreduced phase, it can free up other accounts to keep compounding longer. But if the pension is large enough, it can also push you into higher brackets later or trigger OAS clawbacks unless it's coordinated with your other income sources. And then there's what I'd call the tax valley and the tax wall problem, right? Many retirees are going to spend their first few years drawing down their savings, their cash savings, which keeps their taxable income artificially low. It feels really good in the short term, but when CPP, OAS, and RIF income all layer in later, they hit the tax wall and they get clobbered with higher effective rates for the rest of their retirement. And that's why this stage isn't necessarily about chasing a higher investment return. It's about sequencing your income so that your tax story actually makes sense over time. Because at the end of the day, like this whole plan isn't just a financial exercise. Like this needs to work with your actual life. Where will the spontaneous stuff be funded from, right? That last minute trip with friends, the new grandbaby that just got born across the country, the cottage renovation, right? Those impulse yeses. That's where these flex accounts are going to come in. It's often the TFSA or a non-registered account. That's what those are for. They give you spending agility without wrecking your tax plan. But they need to be seeded in advance. The other real life scenario is just around charitable giving. Like how, when your regular employment income stops, how do you want to sustain your charitable giving habits once that regular paycheck stops? If giving's a part of your identity, and for many of you it is, it deserves a line in your plan, right? Like whether that's through annual giving from your retirement cash flow, or maybe planned gifts of appreciated securities that can reduce your taxes along the way. Like all of these things, income sources, tax strategy, giving, lifestyle priorities, they all really need to be woven together into this one picture. Because at this point in the journey, right, where the rubber meets the road, it's no longer about hitting magic numbers or magic multiples of your income. It's about designing a system that's going to fund your life smoothly, predictably, and meaningfully. At the end of the day, that's what real retirement planning actually is. It's not a number on a spreadsheet, but a structure or a system, a living, breathing process that lets you live and feel at peace with how the math works. So here's the bottom line. People who retire in Canada, they don't need to just hit a savings number. They need to build a plan that fits their life. We can boil this down to a couple benchmarks though. At 10 years out, aim for 6 to 8 times your annual income. Focus on scaling your savings and keeping lifestyle creep in check. At 5 years out, target 10 to 12 times your income. Shift towards protecting what you've built and smoothing out that market risk. And at 1 year out, if you're sitting with 12 to 15 times your income, that's exactly when clarity matters most, right? Knowing where your income is going to come from and how it will be taxed. And it seems that's the difference between retiring with confidence and still retiring with questions. And hey, if you're not sure how close you are to those benchmarks or how to fit the tax and income pieces together, that's exactly what we help Canadians with every single day. You'll find a link in the description below if you'd like us to help you run your own numbers. Like we're helping folks get better answers to these types of questions, again, every single day in a way that makes sense for them. I'd be happy to point you in the right direction. Hey, that's all for now. Thanks for watching. I'll see you in the next one.